Hello everyone, Steve Lentz here with Discover Options. Welcome to this edition of the Market Reports. This is for Friday, October 28th, getting ready for Monday, the open on October 31st, 2016. Today we have two reports for you. The S&P 500 Condor Butterfly Timing Report for those of you trading advanced strategies that are delta neutral, market neutral in fashion. And then also the S&P 500 Directional Likelihood Report for those that want a more statistical understanding of where the market could go based upon past behavior. Okay, here is the market condition ending on Friday. Thursday was an upswing day, just barely, with a higher high and a higher low. Friday was a downswing day with a lower high and a lower low. The trend, all this is happening while the close is below the 50-day simple moving average. And when we go to the stochastic 15.3, it's between 1 and 60. All right, pretty broad range, but it's underneath its 3-day simple moving average. So this is a unique market condition that has not even occurred 60 times since January of 2000. Those three actions together, price action, trend, and the stochastic condition that I expressed right there. All right, you could see two of them appearing, both Friday and then 3 weeks ago or so at the beginning of October. So that's what you see on the screen there. So that's the current market condition we are dealing with right now. The Condor Butterfly Timing Report. Now later I'm going to get into greater detail, but for those of you that understand the methodology behind it, let's just go over it real quick. Currently we have a negative edge of 7.8%. All right, that means that it's more likely than usual that Friday's bar will end up having been unfavorable for market neutral option premium selling. All right, that's the way the market condition is, given the behavior of the VIX in the past and all that. We're going to get into detail, but right now we have a definite negative edge at the moment for Condor and Butterfly traders. The statistical likelihood report, you have a lot of blue numbers, meaning that there's a statistical likelihood of more market volatility than usual, given the condition we're in. We're going to dive into the methodology behind all these blue numbers that you see here, but that's what we're looking at. When we go to the using the SKEW adjusted VIX to determine our bands, we similarly have a lot more blue numbers than red, meaning there's a likelihood of more market volatility than normal. Okay, now we're going to get to the methodology and everything. Before that, I want to ask you to subscribe, just to click on the button below. And for those of you that want a free ebook co-authored by myself and Jim Graham, click on the link in the above right, and it'll take you to a screen that you can fill out to get this ebook, Simple Steps to Option Trading Success. Let's move on to the Butterfly Timing Report, Friday's version. We're going to go over why you should pay attention. We'll look at the methodology and then, of course, the current condition and the methodology behind the edge level and the calculations and everything. Why would you look at this report? Well, you might think the market is channeling along like it was in December 31st, but when you crunch through our numbers and you look at the condition back then, there was actually a negative edge at the time, which meant that there was a higher than usual likelihood that the market would be more volatile than what was implied by the option prices. And back then, indeed, the market did get real volatile, especially to the downside. And of course, that might be a cherry-picked example, but it can kind of show you what can happen when you go into a negative edge and there's a greater likelihood for to be rough waters for the Condor premium collection traders. All right, again, here's the condition, and the question on the table is this condition that we talked about earlier a good one for selling option premium through range trading? Through range trading, butters and condors, is this a good one, a good market for doing that? And that's what we try and address here. Here's how we do it. We first observe how much the market actually moves from the given close. That's called actual volatility. Then we look at implied volatility, or what the market move is being predicted by the option prices. Those are two different things. What's being predicted versus what has actually happened. We compare the two in retrospect, and then we label each bar going back to January 2000. We will label each bar whether it was a favorable one for selling premium through butters and condors, or if it was unfavorable for selling premium. through range trading. All right, let's just look at the actual move first. The meat, the meat and potatoes of the methodology here. You could take any given close, look forward in time 21 bars, and ask yourself how far the market moved at the extreme, either up or down. In this case, when we go forward 21 bars, we see that the low down there was the farthest away from the close. It went up, but it didn't go up near as much as it went down. This turned out to be a 50-point move, which was 2.4% from that close back on, April 28th or so. All right, now here's the question. What market move was being implied by the option prices? We know how much the market moved, but what was being implied by the option prices? And to do that, we go to the VIX. All right, and we can skew adjust it and everything. But what we have here, just taking the core VIX, it was a 4.4% implied move. What was actually the move? 2.4. So in this case, the market moved far less than what was being implied. And what we would do, in our methodology is we would paint those bars blue that had higher implied moves than what actually came to pass. And that's what you see here. All those blue bars occurred when the implied was higher than the actual. And then if you look at the red bars on the left, all right, you go from the close moving forward 21 bars. In that situation, the market moved more than what was being implied. Okay, those were unfavorable bars in hindsight for selling premium through butters and condors. All right, so what we're going to do is look at historically what percentage of all the bars going back were favorable. In the SPX, going back to January 2000, how many were favorable? What was the percentage? Then, once we understand that, then we're going to look at all the bars that match our current condition as of Friday. And we're going to, and in this case, they were like, 55 to 60, something like that. We're going to look at what percentage of those 55 or 60 turned out to have been favorable. If there's a big difference, if we find out that all the bars that match our current condition turned out to have been favorable, okay, I think we would be more aggressive about putting on butters and condors, right? What if we find out that none of those bars were favorable? They were all red. Well, then we would back off easily. We would back off and not do butters and condors with that understanding. That's never the case. You never have 100% one way or the other, as much as I've tried. Okay, but at least we have something to work with here. If there's a big difference between the two, then that could represent an edge, either positive or negative. Okay, I think we understand that. In this case, we can go back to January of 2000 and all 4,230 bars or so. Of all those over 4,200 bars, 65% turned out to have been favorable for selling premium through butters and condors. 35% meant rough sailing ahead. Okay, so that's the baseline understanding that we have in the SPX market. Now, of all those bars that match our current condition, 55 to 60, all right, what percentage of those were historically favorable for selling premium? All right, and when we run the numbers, turns out we had about 57.2% of those 55 to 60 bars turned out to have been favorable. Now that's a lot less than the baseline of 65, right? So we can understand now that we have a negative edge here. You know what? That should be 42.8%. Excuse me. What is this? 57.2. Let me make that a 4. I don't know what happened there. There we go. 42.8%, not 32. You get my math there. All right, so this means that there is a higher than usual likelihood that the market will be more volatile than what is implied by the option prices. All right, so this accounts for the negative edge that we have. And so that's it for the timing, for the butterfly timing report. Right now, it looks like, given this condition, now you could always put a butter condor on, and you have a 57.2% chance that you'll have, clear sailing, that the market won't move as much as what's being implied, and that's fine. Just be aware that normally you'd have a 65% chance. Here you have about a 57.2% chance. So hopefully that's helpful for you as a sophisticated option premium collection type trader. Okay, before we get going on the other report, I want to make sure you understand that we have a fantastic mentoring program here at Discover Options. Whether you're a beginner or an intermediate or an advanced trader, we could definitely help you, take you to the next level. We have money managers that have come to us for help, and we have a great set of instructors that they themselves manage money. They come from the floor of the exchange, and we'll walk you through all the steps for you to become an expert trader in as short a time as possible. We have a very progressive way for you to learn. We give you the tools in OptionView for you to test the strategies and drill yourself and test your skills with real data from the past. Okay, so give us a call. Check out our website at discoveroptions.com. Explore around. We would love to hear from you and help you on your adventure in becoming a better trader. All right, let's look at the market likelihood report. As I mentioned, we have a lot of blue numbers. Let's explore what these really are. What we're going to do is look at our current condition, and here is the question on the table. Since January of 2000, how often has this same market condition occurred? I already said 55 to 60. And what did the market do in terms of direction and volatility? So we're going to go back and look at those 55 to 60 events that match this current one. And we're going to look and see what the market did. Now, how do we do that? What's our methodology? Here's what I like to do. I look at the distribution of price. We want to understand the historical distribution of price. Then we're going to look at the distribution after a condition develops, the one I just expressed. We're going to look at the distribution for each of those 55 to 60 events in the past. We'll compare the two distributions, the baseline one versus the one for our market condition, and if there's a big difference, well, we're going to examine it and make some conclusions. All right, so that's how we do this. Now let me show you how we look at historical distribution of price. I like to measure this by observing how often price touches a 1 standard deviation volatility band that's placed from each bar's closing price, 5, 10, and 15 days. All right, I use a 20-day statistical volatility, and it's log normally distributed. Okay, here's an example. I take a close. In this case, let's just take a close. Right there, and I have a 10-day band set up to, above the close, 1 standard deviation 10 days out, using the last 20 days to get my volatility, and we have a lower band set a standard deviation from the close to the downside. Now the question here is for this particular close, did price strike the upper band within 10 days, the lower band within 10 days, or did it wobble in the middle? All right, and if we go forward in time, we'll see easily that the price hit the upper band, and so we record for that particular close that it hit the upper band. Now, for this close, we go to the upper band, the lower band, and we ask ourselves over the next 10 days, did it hit the upper, the lower, or wobble in the middle? And so when we go forward in time and look, in this case, it indeed tried to come down and hit the bottom band, but it didn't. Do you see that? Check it out. It tried to come down to that 1090 level, but it failed to. So in this case, it hit neither of the bands, and that's what we record in our database for developing the statistical model. Now what we do is from every close, we record how often price struck the upper and the lower 5, 10, and 15-day bands. 5, 10, and 15-day bands. We record how often price struck those for every close. And when we run the numbers, here's what we get from January of 2000 through October 28th. Price struck the upper 5-day band 29.2% of the time, the upper 10-day band about 23%, the upper 15-day band about 23%, the lower 5-day band almost 30%, lower 10-day band about 30, and the lower 15, 32.2. So that is our baseline distribution. Our baseline distribution. Now, moving forward, we're going to understand the distribution then after a specific market condition develops. So what we'll do is we'll go back in time, look at those 55 to 60 events, and here you see 4 of them occurring in the last year. And we're going to look at the distribution as of the close moving forward. What happens if the next day, in this case on Monday, if price goes above the high from Friday? What's the distribution if it exceeds the high? What's the distribution if it exceeds the low from Friday? That way, that'll give you, the trader, a little indication of what should happen, what could possibly happen, on the action on Monday. So, but let me just ask you here: if we go back and find, okay, we're going to understand the distribution after our condition. What if we find? Okay, here, let me just go. All right, I'll just go forward here. From the close on Friday, what happened here? Did I not? Oh, I know what I did. Send it back. There we go. Perfect. Oops, time out. There we go. Here's how the distribution worked. Our market condition, all right, as of the close, just moving forward after the close, price out of those 58 occurrences that matched our current condition, all right, it hit the upper 5-day band almost 38% of the time, which is quite a bit higher than 29% of the time. And there it is, about an 8.7% increase. So this is kind of a bullish. All right, that tells you that there's a little bit of a bullish perspective here. The upper 10-day band got struck 34.5% of the time, which is about 11.5% more than that 23% on the baseline. So it's hitting the upper bands on the 5 and 10-day band, 35% or a bit more there. The upper 15-day band, just about the same, slightly more. Look at this. It hit the lower band similarly more often than the baseline, although the differences are a little bit less than on the bullish side. You see that? So this is a picture of increased or higher levels of market volatility when price is striking both the upper and the lower bands more often than the baseline. This is an indication of more general market volatility. Here we're leaning a bit bullish in this case as of the close. Now, let's divide up the distribution if price goes above Friday's high. All right. Here we see that if it goes above the high, we have a bullish, definitely a bullish bias, 30, 30, and 50. Now that might be because we only have 10 incidences there. Yeah, that's just not enough of a population to get too excited about. So we're not going to get too excited about that. That's just not enough. On the downside, what happened 44 times out of 58? And the other 4, I think we're missing 4, probably an inside bar, or it hit both of them perhaps. But what you see here then is that, oh, look at that. Gosh, it nailed it perfectly on that one. If it goes below the low from Friday, you see blue numbers across the board here. A little bit bias here on the lower 5, a bit more of a bigger or a larger number there. So a picture of definite increased market volatility. I like to also readjust these bands so that the volatility input is not just a statistical volatility, but a skew adjusted VIX, meaning that the upper bands have a lower implied volatility than the lower bands, because the out-of-the-money calls have a lower IV than the out-of-the-money puts. So this is more reflective of what the traders are predicting through the SPX cash option prices. Similarly, though, if you look at this carefully, you'll see that we have some pretty big blue numbers here, especially on the bullish side. So this is leaning to the bullish side in this case. All right, so that is the picture for the market likelihood report, in a picture of increased market likelihood with a slight bullish bias. Here are the divided up VIX numbers. The downside VIX, skew adjusted, is at 18.3, and I'm going to use that number when we go and look at a suggested trade idea. I mean, as I said, we have a likelihood for more market volatility, and if you really have to trade and you want to put something on from the bullish side with a little bit of a bullish bias, you might consider a hedged bull put spread. A hedged bull put spread, and here's how we do this. We go out to the puts only, and here's a picture of option views matrix. We're dealing all in puts here. And we go to the at the money put and buy one. We go out 10 points and sell one. We're taking advantage of the skew here where we're selling a higher implied volatility than we're buying. And that acts as a hedge for the bull put spread that we go further out of the money. I skipped several strikes here. And we put on a 20.5 lot here that has a lot more credit coming in than what the cost is of this bear put spread, such that we have a net credit such that no matter how much the market goes up, we're going to make at least that amount there, 624 in that case. And when we analyze it in option view, here's the picture. And you can see no matter how much the market goes up, we're going to make our 7% within about a month or so. If the market does go down, that hedge kicks in. It lifts the left shoulder up, and you know, the more that time goes by, then you'll see this left shoulder coming up, and the break even flares further and further out as we get towards expiration. So that at expiration, if it doesn't go down a full standard deviation, we could make not quite 3 times what it is we're trying to make on the upside. So that just paints a real nice picture. So that could lend itself to a bullish leaning, certainly as a way of selling premium with that bullish leaning that looks like there's a likelihood, at least from the past, that we could encounter here. But that's where we're at this point. Oh, and by the way, here is the profit area. The market certainly could collapse and go into the red that you see down here, but boy, that's a wide area. If the market chops around at all in that time, looks like paints a real good picture here. All right, folks, thanks for joining us. I'm Steve Lenz with Discover Options. Good luck trading this week. We'll be back next weekend, same bad time, same bad channel. Take care. Have a great week. Bye-bye.